Welcome to a deep dive into the forces that shape our world's economic landscape. Today, we aren't just looking at numbers on a screen, we are exploring the heartbeat of the global economy, economic fluctuations. Why does the economy boom one year and stumble the next? How do we measure the invisible currents of money and production? Over the next 30 minutes, we will build a comprehensive toolkit to understand gross domestic product, the dance of aggregate supply and demand, and the policies used to steer nations through the inevitable cycles of growth and recession. This is macroeconomics in motion. To understand the big picture, we must start with the fundamental plumbing of the economy, the circular flow diagram. Imagine a system where every dollar spent is a dollar earned. At its simplest, we have households and firms. Households provide labor, land, and capital to firms. In return, firms pay wages, rent, and dividends. This flow of resources from people to production is the engine of our society. But money doesn't just circle between these two. It flows through markets for factors of production and markets for goods and services, creating a continuous loop of economic activity. In the real world, the circular flow is more complex, incorporating the government and the rest of the world. The government acts as a massive regulator and participant, taking in taxes from both households and firms and injecting money back through government purchases and transfers. Then we have the international dimension. Goods and services flow across borders as exports and imports, while foreign expenditures on domestic goods add to the internal flow. When we talk about economic health, we are really talking about the volume and velocity of these four factors working in tandem. The headline number we use to track all this activity is Gross Domestic Product, or GDP. It is defined as the total value of all final goods and services produced within a country's borders in a specific time period. It's crucial to understand that GDP is a coincident indicator. It shows us the current state of the economy. If the circular flow is the heartbeat, GDP is the blood pressure reading. It captures the aggregate output of millions of transactions, providing a snapshot of a nation's productive capacity and overall economic wealth. There are two primary ways to calculate GDP, and the most common is the expenditure approach. This method looks at who is buying the final output. We sum up four components: consumption, C, which is household spending; investment, I, which is business spending on capital and infrastructure; government purchases, G, covering everything from military equipment to highway construction; and net exports, NX, which is the value of exports minus imports. This formula, GDP equals C plus I plus G plus NX, is the cornerstone of macroeconomic measurement. Let's look closer at the expenditure components. Consumption is usually the largest piece, reflecting the day-to-day spending of millions of people. Investment, however, is often the most volatile. It represents resources used to grow the economy's future capacity. Government purchases don't include transfer payments like Social Security because those aren't purchases of new goods. Finally, net exports accounts for our interaction with the global market. If we import more than we export, it's a drag on current GDP, but it might reflect a high domestic demand for foreign variety. The second method is the income approach. If the expenditure approach tracks where money goes, the income approach tracks where it comes from. It sums up the total income of households, firms, and the government. This includes labor income, the wages and benefits paid to workers, and capital income, which consists of interest payments, dividends to shareholders, and money paid to landlords. Because every dollar spent on a good must eventually become income for someone involved in its production, the expenditure and income approaches should, in theory, yield the same GDP figure. Now, we must distinguish between nominal GDP and real GDP. Nominal GDP is calculated using current prices, which can be misleading if prices are rising due to inflation. To see true economic growth, we use real GDP, which is adjusted for price changes. Imagine a country produces 10 cars in year one at $20,000 each and 10 cars in year two at $30,000 each. Nominal GDP rose, but the actual output stayed the same. Real GDP filters out that noise to show us the actual volume of production, giving us a clearer view of a nation's real prosperity. While real GDP shows us what we are producing, potential real GDP shows us what we could be producing. It represents the level of production the economy will move toward in the long run, assuming unemployment remains at a normal, sustainable rate. Think of it as the economy's speed limit. When actual GDP is below potential, we have idle resources and high unemployment. When it's above potential, the economy is overheating, which often leads to rising prices. Understanding the gap between actual and potential GDP is key to making sound economic policy. To navigate the future, economists use various indicators. Leading indicators, like the stock market or building permits, tend to change before the rest of the economy, offering a glimpse of what's coming. Coincident indicators, such as GDP itself, move in lockstep with the current state. Finally, lagging indicators change only after a trend has already been established. Unemployment is a classic example. A business might wait months into a recovery before hiring new staff, making the unemployment rate a lagging signal that a recession has truly ended. One of the most critical variables in any economy is inflation, the long-term increase in the general price level. We measure this using the Consumer Price Index, or CPI, which tracks the cost of a basket of goods bought by a typical household. By comparing this index year over year, we calculate the inflation rate. While moderate inflation is normal, high inflation creates menu costs, the actual costs firms face when they have to change their prices constantly. Deflation, the opposite trend, can be even more dangerous, often signaling a deep economic stagnation. Economic activity isn't a steady climb. It's a series of waves known as the business cycle. This cycle is defined by periods of expansion, where production and employment rise, and recession, where they fall. The peak is the highest point of activity before a downturn begins, while the trough is the absolute bottom, signaling that the next expansion is around the corner. These fluctuations are inevitable in a market economy, driven by shifts in consumer confidence, technological breakthroughs, and changes in government policy. To model these fluctuations, we use the aggregate demand and aggregate supply framework. The aggregate demand, or AD curve, represents the total amount of goods and services demanded at different price levels. It slopes downward because as prices fall, people feel wealthier and spend more. The aggregate supply curve, meanwhile, shows what firms are willing to produce. We distinguish between the short-run aggregate supply, or SRAS, which can fluctuate with prices, and the long-run curve, or LRAS, which is vertical at the potential GDP level. Equilibrium occurs where these curves intersect. What causes the aggregate demand curve to shift? Government policy is a massive lever. If the government increases spending or cuts income taxes, it puts more money in people's pockets, shifting the AD curve to the right. Conversely, if the central bank raises interest rates, borrowing becomes more expensive, spending drops, and the AD curve shifts to the left. These shifts directly impact the equilibrium price level and the total amount of real GDP produced, which is why fiscal and monetary policy are so hotly debated. Other factors shift AD as well. Foreign variables, like exchange rates, play a huge role. If the domestic currency weakens, our goods become cheaper for foreigners. Exports rise, and AD shifts right. Household expectations are also crucial. If people expect a recession, they might start saving more and spending less just in case, shifting AD to the left and potentially causing the very recession they feared. This psychological component makes economic forecasting incredibly difficult, as human behavior doesn't always follow a simple mathematical formula. On the production side, the short-run aggregate supply curve shifts based on the costs of doing business. If labor costs or the price of essential resources like oil spike, it becomes more expensive to produce, shifting the SRAS curve to the left. This is often called a supply shock. On the positive side, an increase in the labor force, a larger capital stock, or a breakthrough in technology will shift the SRAS curve to the right. This represents an increase in the economy's productive efficiency, allowing us to produce more goods at the same price level. Macroeconomic equilibrium is the state where the quantity of goods supplied equals the quantity demanded. When the economy is at long-run equilibrium, the AD, SRAS, and LRAS curves all intersect at the same point. This means the economy is producing at its potential GDP and unemployment is at its normal rate. However, shocks to either demand or supply can knock us out of this balance, creating either a recessionary gap, where output is below potential, or an inflationary gap, where the economy is pushing beyond its sustainable limits. A key relationship in macroeconomics is the Phillips curve, which demonstrates the inverse link between the unemployment rate and the inflation rate. Generally, when unemployment is low, the labor market is tight, wages rise, and inflation tends to go up. When unemployment is high, there is less upward pressure on prices. This creates a trade-off for policymakers. Should they focus on keeping prices stable or on keeping people employed? While this relationship holds in the short run, it often breaks down in the long run as people adjust their expectations. When an economy falls into recession, how should the government respond? The Keynesian solution focuses on aggregate demand. Keynesians argue that during a downturn, the main driver of growth is spending. They advocate for the government to increase its own purchases and for the central bank to lower interest rates. By artificially boosting demand, the government can shift the AD curve back to the right, closing the recessionary gap and jump-starting the economy. This demand-side approach was the primary tool used to combat the Great Depression. An alternative perspective is the supply-side solution. Rather than focusing on spending, this approach focuses on expanding production. Supply-siders advocate for lowering taxes on businesses and individuals and reducing government regulations. The goal is to make it cheaper and easier for firms to produce, shifting the SRAS curve to the right. By increasing the total supply of goods, they aim to lower prices while simultaneously increasing output and employment. This production-first mindset became particularly prominent during the economic reforms of the 1980s. Now, let's talk about the human side of economic fluctuations: unemployment. To measure it, we first define the labor force, all members of the population who are able to work, including those currently employed and those who are unemployed but actively looking. People who aren't working and haven't looked for a job in the last 4 weeks are considered not in the labor force. This includes retirees, students, and discouraged workers, people who have given up searching because they don't believe any jobs are available for them. Unemployment isn't just one category, it's split into 4 distinct types. Frictional unemployment is natural. It's the time it takes for people to find the right job match. Seasonal unemployment is also predictable, affecting industries like tourism or farming. Structural unemployment is more serious. It occurs when there's a fundamental mismatch between worker skills and what the modern economy requires. Finally, cyclical unemployment is the one tied directly to the business cycle. It exists only because of economic downturns and is the primary focus of macroeconomic policy. To quantify these trends, we use 2 key metrics. The labor force participation rate is the percentage of the working age population that is actually in the labor force. The unemployment rate is the percentage of that labor force that is currently unemployed. It's important to remember that full employment doesn't mean zero unemployment. It means there is no cyclical unemployment. People are still moving between jobs or retraining, but the economy is expanding at a healthy, sustainable pace. The link between unemployment and GDP is captured by Okun's law. It states that for every 1% rise in the unemployment rate, a country's GDP will be about 2.5% lower than its potential GDP. This rule of thumb highlights the massive cost of a recession. When people lose their jobs, the nation doesn't just lose their income, it loses the actual goods and services they would have produced. This output gap represents a permanent loss of wealth that can never be recovered. Let's apply what we've learned to a case study, a major demand shock. Imagine a scenario where consumer confidence plummets. Households stop spending, shifting the aggregate demand curve sharply to the left. The result is a drop in the price level and a significant fall in real GDP. As output drops, cyclical unemployment spikes. To fix this, a Keynesian policymaker would recommend a stimulus package, increasing government spending to shift AD back to the right and restore the economy to its long-run potential. Now, consider a supply shock, like a massive increase in the price of natural resources. This makes production more expensive for almost every firm, shifting the SRAS curve to the left. This creates a nightmare scenario called stagflation, where the price level rises while output falls and unemployment climbs. Unlike a demand shock, there is no easy fix here. Boosting demand would raise prices even further, while cutting demand would worsen unemployment. In this case, supply-side solutions like tax cuts or deregulation are often the only way to help firms lower costs and restore supply. Finally, let's look at the impact of technology. A breakthrough in artificial intelligence or renewable energy can shift both the SRAS and the LRAS curves to the right. This represents a fundamental increase in our productive capacity. As supply grows, prices tend to fall while output and real wealth increase. This is the Goldilocks scenario of economic growth: higher prosperity with lower inflation. It reminds us that while we spend a lot of time worrying about short-term fluctuations, the long-term health of an economy is driven by innovation and productivity. We've covered a vast amount of ground today, from the basic circular flow to the complexities of stagflation and supply-side policy. We've seen how GDP, inflation, and unemployment are not just isolated statistics, but deeply interconnected variables that define the lived experience of millions. Whether it's through the lens of Okun's law or the shifting curves of the ADAS model, you now have the tools to analyze the headlines and understand the hidden forces that drive the global economy. Thank you for joining me on this journey through the world of macroeconomics.